All right, let's jump right in. If you've ever stared at a corporate financial report and felt like, I don't know, you were trying to read an ancient, untranslated language, well, you are definitely not alone. But today, we're going to demystify all of that. Think of this explainer as a medical exam for a business's financial health. Okay, let's dive into this. We are going to take this seemingly impenetrable wall of numbers and transform it into a crystal clear narrative that you can actually use.
So, I want you to ask yourself, how do you read a company's financial story? Because, most people just skip to the final profit number and stop right there. But honestly, that's like reading the very last page of a mystery novel and pretending you understand the whole plot. Today, we're taking a pretty dense glossary of financial terminology and translating it into a clear three-part narrative. By the time we're done, you're going to know exactly how to trace the plot of any business.
Here is our quick roadmap for today. First, translating financial statements. Then, the balance sheet snapshot, followed by the income statement story. Next, tracking the cash flow, and finally, the complete financial picture. Part 1. Translating financial statements.
Part 2, the balance sheet snapshot. All right, think of the balance sheet as the company's bone structure and weight, literally frozen in time. Officially, a balance sheet is a financial statement showing company assets, liabilities, and equity at specific reporting dates. But in plain English, this is your freeze frame. It tells you exactly what the company owns, exactly what it owes to everyone else, and what's actually left over for the owners at one single point in time. And here is the engine that drives that freeze frame, the core equation. Total assets represent the combined value of everything the company owns that provides future economic benefits. Total liabilities, those are the obligations owed to creditors, suppliers, and lenders. And total equity is the owner's residual interest after you subtract those liabilities from the assets. So the crucial point is that these three elements must always balance out perfectly. Assets equal liabilities plus equity. It is the absolute foundation of everything we're looking at.
Now, let's break down those assets by just looking at the clock. Current assets are expected to be converted into cash or consumed within one single operating year. So think of highly liquid cash and equivalents, inventory waiting to be sold, or accounts receivable waiting on customer payments. It's kind of like the cash sitting right there in the register. On the flip side, long-term assets like property, plant, equipment, and intangible assets like patents, well, those are intended to provide economic benefits way beyond that one-year mark. Think of that as the actual warehouse building itself.
And that exact same time-based logic applies to what the company owes. Current liabilities are obligations payable within 1 year, like accounts payable to suppliers or short-term debt. You've got to pay these immediately using current resources. It's an immediate crisis you have to manage. But long-term debt, those are borrowings you repay beyond 1 year. These are the funds supporting long-term business financing and strategic growth. They aren't an immediate crisis. They're a structural choice. Okay, let's look at the final piece of the balance sheet equation, equity. Here, we contrast common stock with preferred stock. Common stock represents the basic ownership shares. They give you voting rights and residual claims on company earnings. But preferred stock? That grants priority dividends and claims over common shareholders during distributions. It's literally like having a VIP pass to the company's financial payouts. You jump ahead in line for the money, but you're often trading away your voting power to do it.
Now here's a truly fascinating metric: retained earnings. This represents the cumulative profits reinvested back into the business after dividends are distributed to shareholders historically. Why does this matter so much? Because retained earnings act as a critical bridge. It's the living memory of the company's past successes, showing you exactly how much historical profit has been locked back into the company to fuel future value, rather than just being handed out to investors.
Let's move to part 3, the income statement story. So, officially, the income statement is a financial statement reporting revenues, expenses, and profits earned during accounting periods annually. But unlike the static freeze frame of the balance sheet we just looked at, this statement actually tells a story. It's like pressing play on a motion picture. This is the heart rate of the company, showing us all the action and effort over a continuous year. It shows us how effectively the business takes its starting resources and actually generates a return.
The best way to understand this is through what I call the profit waterfall. We start at the very top with total revenues. That's all the income generated from operations before you deduct any expenses. But you can't make something for nothing, right? So we immediately deduct the cost of revenues, the direct costs incurred to actually produce those goods or services. What remains is your gross profit. And it's absolutely crucial to realize it is exactly that, gross. It's unrefined. This is just the very first ledge of our waterfall. Because we definitely aren't done shedding costs yet. From that gross profit, we have to deduct operating expenses to see what it costs to run the business day to day. This includes R&D expenses for developing new products, it includes selling, general and admin expenses for management, sales, and marketing, and it includes other miscellaneous operational costs. Basically, these are the necessary burdens of keeping the lights on, paying the management team, and, keeping the break room coffee machine fully stocked. And here is the second half of our profit waterfall cascade. After deducting those operating expenses, we land on operating income, which is profit from core activities. Next, we have to subtract net interest expenses and income tax expenses. We factor in borrowing costs and the often painful reality of what is owed to the government. Finally, we'd reach the bottom of the waterfall, net income. This is the absolute final company profit remaining after completely deducting all business expenses and obligations. It is the true bottom line. Part 4. Tracking the cash flow. All right, now we need to look behind the curtain at the company's circulatory system. The cash flow statement is a financial statement showing cash inflows and outflows from business activities during reporting periods. This statement is all about reality. Why? Because a company cannot pay its bills with accounting theories. It tracks the actual physical movement of cash in and out of the business. Ultimately, positive cash flow is the true lifeblood of business survival. The structure of cash flow rests on 3 distinct pillars. And this brilliantly illustrates the 3 distinct ways cash moves. First, operations. That's the net cash provided through daily business activities. Second, investing. Cash flows related to purchasing or selling long-term assets, like capital expenditures or divestitures. And third, financing. The cash resulting from borrowing, repaying debt, issuing shares, or paying dividends. Every single dollar that moves falls into one of these 3 buckets. Let's unpack that first pillar, cash from operations. This section reconciles the accounting profits we saw earlier with the cold, hard reality of cash. It literally starts with that net income figure from the income statement. Then it adjusts for non-cash items. For instance, it adds back depreciation, which, think about it, is like your car losing value over time. It's a recognized loss on paper, but you aren't actually handing someone cash for it today. Finally, it factors in changes in net working capital to reveal the true cash generated by daily operations. Looking at investing cash flows, we see a fascinating contrast: capital expenditures versus divestitures. Capital expenditures, or CapEx, are funds spent acquiring, upgrading, or maintaining long-term physical, operational assets. It's cash flowing out to build the future. Divestitures, conversely, represent the disposal or strategic sale of business units or operational assets. It's basically selling off pieces of the present to bring cash flowing right back in. And in the financing bucket, look at how a company manages its equity. Issuance of common stock means the company is raising capital by selling ownership shares to investors. Cash flows in. Repurchase of common stock is the exact opposite. The company uses its cash to buy back previously issued shares, which reduces outstanding ownership equity balances. Cash flows out, sure, but the remaining slices of the pie get far more valuable for the existing owners. Finally, Part 5, the complete financial picture. So we've looked at the balance sheet, the income statement, and the cash flow statement. But these aren't isolated documents. They form one single interconnected organism. Here is the magic link that ties the entire story together. Look at net income, the bottom line of the income statement. That single number feeds directly into the balance sheet by increasing retained earnings, building the company's equity. Simultaneously, that exact same net income figure jumps over to the cash flow statement, where it acts as a starting point to calculate cash from operations. It is a perfect closed-loop system. So I want to leave you with this final thought to ponder. We've seen the frozen snapshot of the balance sheet, the performance story of the income statement, and the harsh reality of the cash flow statement. Which of these 3 financial statements do you think reveals the most dangerous secrets of a business? The next time you look at a company you want to investigate, apply this explainer framework. Start reading the actual story, not just the ending. Thank you so much for learning with me today, and keep exploring.